Hello, good afternoon, and a very, very good welcome to you all. Delighted to say that David Wiscombe is back with me today, back in the black chair.
Always a pleasure to come back to Finchley to renew old acquaintances and fail to recognise half the people here. Yes, always a pleasure.
And sorry for those of you who's watching of the Cricket World Cup we're interrupting, but we should probably mention it's a grey, cloudy day here in Finchley, just in a little tribute to them. But enough, David. What are we talking about today?
Well, I thought we'd talk about share buybacks and the alternatives to share buybacks. Legislation has been allowed to do it for many years, but nonetheless, there are some interesting points.
There certainly are, and it's not just the tax we need to consider, also the company law aspects. The two do interact, don't they?
Yeah, absolutely. Though I think we may need to emphasise at the outset that when it comes to the company law aspects, it's generally not a bad idea to talk to a company lawyer, and we'll see what can go horribly wrong in a particular case where practically everything that could go wrong did go wrong from a company law aspect, which caused some interesting tax issues.
Yeah, and similarly from a tax perspective, there's a number of pitfalls, and without wishing to give too much away what we're going to cover, capital treatment, 10% tax rate potentially, income tax treatment, 38% tax. And there is that tension in the tax system, which means it is so important you get this right.
Absolutely.
Okay, so go on, David.
So without more ado, why would you want to sell your shares back to the company, or indeed why would the company want to buy them? And I suppose there are three circumstances. One is you might be retiring from the company, going off into the sunset, and hopefully taking the value of your shares with you. You might simply be in the position where you can no longer work in the same premises as your co-directors and shareholders, so there might be a dispute that requires the company to be split up, or you might just need to take some cash out of the company. Buying shares back, releases some cash.
It doesn't always have to be a dispute, though, does it? It may be one shareholder wants to go a separate way, other shareholder wishes to stay on board, but they're not looking to bring on board a third-party investor.
I mean, in other words, some divorces can be perfectly amicable.
Okay, all right. Not met my wife, have you? No. Okay.
Yeah. So you might say, simply taking cash out is no chance at all of getting capital treatment, but we'll see, shall we?
Okay. And fundamentally, as we've already alluded to, there's really two tax treatments, aren't there, on a share buyback, David?
Yeah. Income or not income. Well, income or capital.
Mm-hmm.
And everybody knows, don't they? Everybody knows. There's some things in tax that everybody knows. Like, if you sell your house, you don't pay any capital gains tax. Everybody knows that, right or wrong. If you have an agreement between an employer and an employee that says you're not an employee, then you don't operate pay as you earn. Everybody knows that as well.
Couldn't be clearer.
Both manifestly wrong, of course. And everybody knows that if the conditions for capital treatment aren't met, then everything you get back is subject to tax. As income, as a distribution.
But that's not strictly true. Well, it's not true at all, is it, David?
It's not true at all.
If we have a look at...
That's the point. It said it isn't true. I mean, returning the amount that is originally subscribed for shares isn't a distribution at all, and you don't get as far as the question about whether it's capital or income under the buyback rules.
And that's crystal clear in section 1000 of CTA 2010, isn't it?
Yeah, well, I'll go for crystal clear. Yes, I'll go for crystal clear.
Pretty clear.
It talks about any other distribution out of the assets of the company in respect of shares, except so much as represents a repayment of share capital. So we have a simple example, I think.
Okay. There we go.
We've got the entirely fictitious BKL Property Investments 2019 Limited. And this hypothetical company has a share capital of £100, share premium of £1 million, investment property of £1 million, and cash of £100. This might be a company where the property has been transferred to the company in exchange for shares. There might have been a holdover under section 162, but whatever. We've got shares where we have actually paid £1 million for the shares.
Yeah, and just to be clear, the capital you've paid on the shares does include the premium, doesn't it?
Absolutely.
Although,
yes.
Not wholly specific, but absolutely, that's a given, isn't it?
It includes the premium, but of course there may be circumstances in which there is no share premium recognised for accounting purposes. but you've nonetheless paid a premium for the shares. And the classic example would be where a holding company has acquired a subsidiary on an issue of its own shares, where my understanding is that you wouldn't create a share premium in those circumstances because of something that you accounting chaps tell me is called merger relief.
Oh, you're looking at me. I'm not one of those chaps.
Something of that kind. So the point is, you need to look at what was the price that was paid for the shares. And in this example, the price that was paid for the shares was £1.1 million. So if 50 shares are being bought back for £500,000, all you're getting is a return of capital. There is not a distribution. So the question about whether it's an income or a capital distribution just doesn't arise. You're simply getting your money back. We've got the next slide that emphasizes that. It includes basic law. The distribution is any other distribution out of assets of the company in respect of shares in the company, except however much, if any, of the distribution represents repayment of capital on the shares.
Okay, so that's section 1000 we referred to earlier. You do need to be careful if you've got second-hand shares, though, don't you, David? Because you can end up, if we give another example, so David Wiscombe, Top Tax Tips Limited, issues me with 100 shares for £100, and I sell them on to somebody for £300. But you immediately buy back his shares for the £300. Now, if it's capital treatment, he sold them for 300, they cost him 300, no gain, no loss. If it's income treatment, and we'll come on to when you get income and capital treatment shortly, then I've got a bit of a problem, haven't I? Because the amount of capital is 100.
Yeah, absolutely. I mean, you look at CTA 2010, section 1001AB. How much was the capital paid for the shares, subscribed for the shares?
And that's the £100 that I originally paid.
Absolutely.
So you've got a distribution of 200, and if you do the maths, you get an equal and opposite capital loss of 200. So notwithstanding, poor chap over there has made no economic gain or loss, he may well hand up a tax liability. So be careful with second-hand shares. Use the legislation tells you exactly what you need to do here.
Yeah.
Okay. So enough warnings.
And what have we got here? We have a question. We mentioned share premium as a result of section 162. You don't need to be careful. You don't need to be careful about the rolled over gain. You might indeed need to be careful about. If we go back to the example of the, have we got a technology to go backwards?
Yeah. Oh, I think we have. Is that going forward? No, that's going forward, isn't it?
Here we go.
Went too far.
If we're looking here at whether there is a distribution for tax purposes. In that case, we've paid £500,000 for the shares. As a matter of fact, as a matter of company law, as a matter of fact, we have paid £500,000 for the shares.
Right.
Therefore, if the company buys the shares back for £500,000, there is no distribution for income tax purposes. So you are dealing with a disposal of the shares for £500,000. Now, it might well be the case that the base costs for capital gains tax purposes might be less than £500,000 because we've had relief under section 162 on rolling the asset into the company. But that isn't the point we're looking at here. The point we're looking at here is whether the amount repaid on the shares is a distribution. It's not a distribution, it's a capital payment, and the consequences flow from that, which as our querer, person raising the query, says, there may be a capital gains tax charge because of the section 162 relief.
Yeah, so there's a further complication, it's absolutely right, but doesn't wholly interact with what we've been talking about so far. But thank you. And if any of you have questions, do type away. We will endeavour to answer as many as we can during the course of this webinar. So where were we? We were going to talk about now the meat of it, purchase of own shares. When is it not a distribution, David?
Well, you'll see that I've added some words into the legislation there that aren't actually there. So a payment that would otherwise be a distribution and is made by a company on the redemption, repayment, or purchase of own shares is not a distribution if certain conditions are fulfilled. but I put those words in to remember that they are implied by the legislation. If something wouldn't otherwise be a distribution, the purchase of own shares legislation can't turn it into a distribution. That's important to remember. Might be not overemphasizing this, am I?
No, I think so. Okay. And just for those who are playing along at home, this is section 1033 of the 2010 Act. Yes, David?
This is section 1033, okay. Yeah. So a payment that would otherwise be a distribution and is made by a company on the redemption, repayment, or purchase of own shares is not a distribution if, one, the company is an unquoted trading company,
yep,
or the unquoted holding company or trading group, and one of two conditions is met, which we'll call condition A and condition B, because for no better reason, that's what the legislation calls them.
Okay, but then we need to be careful here, and as we said, there's lots of potential bear traps here. We need to define what we mean by a trading company, a trading group, and it has its own unique definition for these purposes, doesn't it? Which is squirreled away in the legislation.
Yeah, I don't think this definition of trade is found anywhere else in the Act. But trade for this purpose doesn't include dealing in shares, securities, land, or futures.
Yeah, I think that's right. And it's section 1099, isn't it? It's sort of, as I say, hidden away at the end there.
It's yeah, you so often have to it's dangerous to make assumptions about anything in tax. That you think you understand what the words mean, but then you find that they mean something else because they've been defined as something else.
And it's right at the end of this section, isn't it? You may well have given up.
Yeah, it's indeed right at the end.
And it's that defines what a qualifying trade is, as it were. But a trading company is one whose business consists wholly or mainly of carrying on a trade or trades.
Yeah.
And wholly or mainly, I read as, well, more than 50%.
Yep. Yep. Yeah, I mean, whether it's 50% of assets, time, profits, turnover is the same difficulty you get in any sort of quantitative assessment of trading. The same sort of thing arises when you're looking at a trading definition for entrepreneurs relief purposes, where you're looking at the activities not including to a substantial extent non-trading. Well, what does mainly mean? What does substantial mean? Well, mainly, as you say, means mainly, more than half. 50.0001% is mainly. But it's worth appreciating, therefore, that a company can be a trading company for the purposes of the company purchase of own shares legislation that potentially creates, therefore, a capital payment on a buyback of shares without being a trading company for entrepreneurs relief purposes.
Yes, absolutely.
So, when we were saying at the start of this presentation that it's the choices between the differentiation between paying tax at 10% if it's capital or up to 38% if it's revenue, not quite true. You could be paying capital gains tax at 20% if you have a trading company which doesn't qualify for entrepreneurs relief purposes. So again, there's this layering of the different meaning of trade for different purposes.
Just to clarify the point, the question's been asked: so a property investment company is not a trading company for these purposes. Can't be. It's talking about dealing in property as far as the definition of a trade goes in section 1099.
Yeah, I mean, a property investment company isn't a trading company because it's not a trading company.
End of.
If it were dealing in land, it would be carrying on a trade, but it wouldn't be a trading company for these purposes. Property investment companies don't get past off the starting line.
Agreed. Now, so already we can see there's a number of grey areas here. What can bring clarity is a tax clearance.
Yes. The Board of Inland Revenue. Are they still called that?
I think so.
Yeah. Has a fine sort of 19th century ring to it, that doesn't it? You envisage them sort of sitting around a mahogany table, considering
in top hats, yes.
Yeah, considering the matters that are
a glass of port, yes.
Yes. The commissioners in there. Anyway, the Board of Inland Revenue have been good enough. Well, actually, Parliament has been good enough to require the Board of Inland Revenue to give clearance or fail to give clearance when it is sought. The company is entitled to put the facts before the board at any time before making payment, put them the facts before the board and say, come on guys, is this going to be a payment that falls within section 1033 as being a capital payment, or is it not within 1033? It's important to appreciate that clearance is not compulsory. It is not the case that if clearance isn't sought, income treatment applies. Sometimes people think that if you don't get prior revenue comfort that capital treatment applies, that the income treatment automatically applies. That, of course, is not the case. All you're asking is for the revenue to confirm their view of what it will be. And clearance is either way. It is confirmation that the capital route applies or the income route applies. Either the conditions for it to be capital are met or they're not met. So you get a positive clearance either way,
yes,
income or capital.
And rather splendidly, not only is there a clearance process, in Statement of Practice 282, they set out exactly what you should put in that clearance.
They do indeed, yes.
So yeah, just copy, it's almost a pro forma in there, which I haven't seen for any other type of clearance, to be honest. Yeah. So it's all in there, put the information in, and HMRC will opine, are you a trading company, but also whether they think you satisfy all of the other many conditions. So clearly you need to give them sufficient information to comment on that.
Yeah, and obviously you need to give full information and accurate information. You need to put all your cards on the table face up, I think was the description that was given in one case, if you're to rely on the clearance. SP 282 that you mentioned, by the way, also we'll talk a bit more about the trade benefit test, and the circumstances in which it's accepted that a payment is made for the benefit of a trade carried on by the company or by a subsidiary. And SP 282 is not only sets out the procedure and the template, it also gives some quite useful guidance on when the revenue think the trade benefit test is met and when they think it isn't met. So we'll talk about that in a bit. And the other interesting thing about the clearance is that it is a clearance. It's what I think of as a full clearance. Contrast that with clearance under section 138 on a share-for-share exchange, where you're only asking the revenue if the legislation that would
for bona fide commercial reasons,
that would cause there to be the statutory fiction that there's no disposal.
Yeah.
You're only asking the revenue whether that statutory provision is disapplied by reason of there being a tax avoidance motive. Technically, the revenue could give you clearance under section 138 saying we agree that this legislation is not disapplied by reason of there being a tax avoidance motive. And then once you've done the transaction, come back to you and say, ha ha, caught you, the legislation doesn't apply anyway, because you don't meet the basic conditions for the legislation. Yes. So whether there's a tax avoidance motive or not is irrelevant, because you still go and get the relief. And in fact, section 138 clearances have a caveat at the end saying, we, the revenue, are saying nothing about whether you actually get the relief. We're only commenting on whether there's a tax avoidance motive. Not so for the clearance on purchase of own shares. Clearance on purchase of own shares, it is a clearance that it's capital or it's revenue.
It's more than that as well. I have to say, I thought it was quite remarkable once. I saw a copy of correspondence with the revenue on a share buyback clearance, where the revenue said, actually, technically you fail. I can't remember on which point it was. But then they went, you might want to do it this way, because that would allow you capital treatment. So I thought that was quite splendid of them, giving tax advice.
Absolutely. Obviously somebody looking for a career outside of the revenue. It's what you didn't see was the enclosure with the letter that enclosed the guy's CV.
Allegedly, yes.
Allegedly. No, I jest. Yes. So where were we?
We were talking about
clearance.
And just for completeness, I think you would normally ask for clearance under the normal transaction and securities rules. And as we'll look at later, there is a notification you have to write to HMRC to inform them that you've done a buyback that you think meets the capital treatments. If you don't go for clearance, then you're going to have to pretty much disclose everything to them then anyhow. So I think as a general rule, we would always suggest you go for clearance if you've got the time, etc., given HMRC's 30-day notice period.
Yeah, I can see. yeah, there are limited circumstances in which you wouldn't want to go for clearance. Yeah, let's leave it at that.
Okay, enough said. Right, we were focusing on condition A, when you get your capital treatment, and we talked about buying for the purpose of the trade. But there's, I think, the ugly sister, isn't there? The lesser well-known reason why you might be entitled to capital treatment that is often overlooked. Enlighten us, David.
I was just musing on whether that was sexist, appearancist, ageist. Just like to, when my colleague refers to ugly sisters, he doesn't mean to imply in any way that sisters are more likely to be ugly than brothers, or indeed that there's anything morally wrong with being an ugly sister. We just like to make that clear.
Thank you very much. Yes. We can edit that out later, can't we?
We can edit that out later.
Okay,
yes.
right.
Yes. With condition B, we'll deal with just to get out of the way, really, because it's very seldom invoked as the reason for capital treatment. Having said that, we'll probably get half a dozen people saying that they invoked it last week, but it's not the most common
No,
condition.
I've never seen it.
I've never used it. It applies if the whole or substantially the whole of the payment, apart from any sum applied in paying CGT on the redemption, repayment or purchase, is applied by the person to whom it is made in discharging a liability of that person for inheritance tax charged on a death, and it's applied in that way within 2 years after the death, and the liability couldn't have been discharged otherwise than by the redemption or repurchase, whatever it is, of the shares in the company or another unquoted trading company. So all of those people who thought on the very first slide that you can't get capital treatment if the only purpose for doing it is sucking cash out of the company were kind of wrong, because you can get clearance if your only reason for doing it is sucking cash out of the company, depending on why you're sucking that cash out and what your other options were for raising the cash.
Yeah.
So notably, the liability doesn't have to be in respect of the shares that are being sold.
Mm-hmm.
Indeed, there very often won't be a liability to inheritance tax in respect of the shares that are being sold, because very often there'll be business property relief on those shares. It just has to be that selling the shares is the only way to access the cash to pay an inheritance tax liability, or the only practical way to do it. So not very common, but we'll cover it. But we've covered it for completeness.
If anyone has seen it, feel free to type now or forever hold your peace. I think that's a no.
No, silent.
No. Okay.
That's
move on.
Right.
So let's go back to condition A, which is, as we said, 99.9% of the time is the one you will look at. You need to show that the purpose of the buyback is wholly or mainly for the purposes of benefiting a trade carried on by the company or one of its subsidiaries.
Yeah. So it's actually a very interesting definition, that, because I mean, typically one of the examples that the revenue give, and one of the most common examples for capital treatment on buying back the shares, is where maybe a founder is retiring from the business and passing on the business to the next generation. It's just withdrawing his capital in retirement. And strictly speaking, it always seems to me that having the founder retire is not actually benefiting the trade at all in most cases. I mean, it's actually a detriment to the trade, because he's the guy that founded it, he's the guy that has all the contacts, he's the guy that's built it up. So the retirement is actually a bit of a detriment to the trade. But happily, the revenue don't take that point. They don't take that semantic point, and they accept that purchasing shares back from a person who is retiring is a payment that's made for the benefit of the trade. Other examples might be, we discussed, there might be a dispute where the shareholders are at each other's throats. They may simply want to part company because there's an amicable difference of opinion as to how the trade should be moved forward.
Yeah.
I remember my wife's grandfather ran a haulage business, and there was an amicable dispute about whether they should buy these newfangled motor lorries. The founder of the company was insistent that they would never catch on. The young lad was suggested that possibly diversifying into these newfangled things was a good idea. And so they amicably parted company. I'm sure they didn't have a company, and if they did, I'm sure there wasn't a company buyback. But that's the sort of example that might have been relevant. What else? Death is another one. If you've got a shareholder in a company who dies and the executives don't want to stay in the company, they want to realise their investment to distribute to the beneficiaries, that would be a circumstance in which buying back would be benefiting the company's trade. Or there might be short-term finance that has been put in by a venture capitalist into the trade to develop the trade, and it might always have been the intention that finance would be in short term and would be repurchased at a later stage. So all of those things are circumstances in which it's likely that the revenue would accept that there is a benefit to the trade from buying the shares back.
And again, there's a bit of guidance in Statement of Practice 282, isn't there, about the sort of circumstances they will accept. Obviously, all non-statutory, but worth having a look at. I mean, the one thing they refer to is, look, you've really got to walk away from the business, is their view. It'd be very difficult to convince them if you are staying on in any sort of formal capacity, etc., etc.
But that said, there are a number of cases where clearances have been given where a founder wants to leave, wants to take his capital out, is passing the business on to the next generation, and he's staying on as a consultant for a defined period of time, part-time, to hand over the reins. That's perfectly acceptable. What you can't do is sell the shares back and continue exactly as before. One of the other I think examples, I'm not sure whether the revenue give it, but is where there's a difference of opinion on whether the company should carry on trading or become an investment company, whether it should sell its business trade altogether. Right. Then the revenue's view is, in that circumstance, a buyback can't be for the purpose of benefiting the trade, because the question is whether the trade continues or not. You're not, and so that's one case in which the revenue won't give clearance. And they do expect, and we'll talk a bit more about the extent to which you need to give up the shareholding. But generally speaking, the revenue are very circumspect about giving clearance where there's any substantial shareholding being retained. I think they say that they're happy for a shareholding of
sentimental 5%
for sentimental reasons. But anything more than that, they're likely to question whether the buyback of the shares is for benefit. So there's that. The redemption, as you see, mustn't form part of a scheme or arrangement to avoid tax.
God forbid, no, we would never do that.
It's a bit of a paraphrase of the legislation, but it's good enough for our purposes. And that test of whether there's a scheme or arrangement to avoid tax or whether you're benefiting the trade are, they're judgmental. They're subjective to some extent. You've also got 4 objective requirements set out in, as I've said, section 1034 to 1043, and they are either they're met or they're not met. And those objective requirements are not relevant to condition B, an IHT repurchase. Right, IHT repurchase and condition B, it's just the conditions that we set out about needing the money to pay IHT.
Okay, and we're going to look at those conditions in a little bit more detail. So we talked about the sort of circumstances as to why or how it might benefit the test, and as I say, have a look at the statement of practice, and I think we've largely covered all those points. And as I say, have a look at the revenues guidance. They even say if you stay on as a consultant, that could preclude capital treatment. I take your point, David. If it's just a short handover period, I don't think that's unreasonable. That is exactly designed to protect the trade.
Exactly, yeah.
So there is a degree of flexibility, but there is guidance there should you need it. So I think that's all we need to say on the benefit of the trade beyond what we've previously said. Let's talk about those objective conditions now.
Yes, right. Well, what do we got? The seller must be a UK resident in the tax year in which the disposal is made. Not entirely clear why, to be honest. I'm not sure what the objection is to the seller being. Anyway, that's what it is. And curiously, even less intuitive, if the shares are held for a nominee, the nominee must also be UK resident. Well, given that a nominee is entirely transparent for tax purposes, and the acts of the nominee are treated as the acts of the beneficial owner, what possible difference can it make whether your nominee is resident in the UK or not? But you know, that's what the legislation clearly says. Perhaps it's there to address some long forgotten tax planning scheme that passed over my head. It was actually quite useful in the old. There have been periods of time when the income treatment was more beneficial than the capital treatment for whatever reason. When by the time you've got credits on the, remember you used to have something called tax credits on dividends, and
last millennium, that I'm afraid, David.
Yeah. There was a time when you actually wanted to go down the route of an income distribution, and by far the easiest way of procuring that was to stick your shares in the hands of an offshore nominee. It was just, well, and people did it anyway. So that's that. So that's the residency bit. Shares being sold must have been held for at least 5 years, and we've got special share identification rules that are strangely advantageous. Actually, shares acquired earlier are taken into account before shares acquired later. So you have a first in, first out rule on those acquisitions. But any previous disposal is assumed to be of shares acquired later rather than the shares acquired earlier. So if you've got a portfolio of shares that you acquired at different dates, and you have meanwhile disposed, not by way of company buyback, but at arm's length, to an actual disposal to somebody else, then when you come to look at which shares you're selling back to the company, the ones that you are left with, in other words, you're assumed to have previously sold later shares rather than earlier shares. So you're left with the oldest shares, and therefore the ones that are most likely to have been held for 5 years. So both of those are helpful.
Blimey.
Yeah. Where you've had a reorganisation and no disposal on a share-for-share exchange, or indeed on a reorganisation or a reconstruction where shares have been passed across either on a liquidation or reduction of capital, and shares issued in consideration, where there's for any reason this no disposal fiction that we talked about in the section 138, then that applies for determining when the shares are deemed to have been acquired. So that's helpful. Though, as we said, if there has been a no disposal fiction, you have to be particularly careful to check whether there is in fact a distribution, or whether the amount that's paid for the shares is a return of capital.
Yeah.
Shares acquired from a spouse are treated as acquired when the spouse acquired them, unless in the interim you've separated from the spouse. The temporary silence here is because my colleague's gone up to cough. Yeah. Oh, he's back again.
Yep. Nobody panic.
I thought you were just walking out of the room on a. Anyway. Yeah. So where shares have been acquired from the spouse are treated as acquired when the spouse acquired them, unless you're separated in the interim, in which case you're then treated as acquiring them when you actually acquired them. And if you've inherited shares on a death or under a will or an intestacy, then you're treated as acquiring them when the deceased acquired them, and then you have to have acquired them for 3 years.
Yeah, it's odd, that one, isn't it?
It is a bit,
but again, all generally works in your favour for once, doesn't it?
Yeah.
So there you go. Right, we'll look now at the substantial reduction. I've always thought this is obviously of academic interest, but to a large extent slightly obtuse, in the sense that the revenue's view is, unless you get rid of all your shares, they won't be convinced you've satisfied the trade benefit test. So
yes, that is true. So unless there's a substantial reduction of, I say, of your shareholding interest, you're unlikely to pass the trade benefit test. But there also needs to be a substantial reduction in the aggregate interest of you and your associates.
Yeah.
and that you might very well have a continued shareholding of your associates. We'll look at what we mean by associates in a minute, and that your associates continue to hold shares won't necessarily compromise your trade benefit test. So it's probably more in the relation to the aggregate interest of sellers and associates that this substantial reduction is likely to be in point. And we have a substantial reduction, and the legislation manages to use fairly confusing language, which I've tried to simplify here. It's a substantial reduction if the subsequent interest doesn't exceed 75% of the prior interest.
So it's not just simply a case of selling a quarter of your shares, is it?
Completely, yes. That's the mistake that people make. They look at 75% in the legislation, think selling a quarter of your shares is okay. It isn't. And your interest is the total nominal value of the shares issued over the total issued share capital of the company. So nominal value, not the market value of the shares, nominal value of the shares over the issued share capital. There is an alternative test that also has to be fulfilled by reference to fractional entitlement of assets if the company would distribute all its profits. So this is to deal with the case where you might have shares with a preferential right to dividends that have a relatively low nominal value, but nonetheless suck out a large proportion of the company's profits. So you've got to satisfy both the substantial reduction in the interest by reference to nominal value of shares, but also by reference to the fractional entitlement if the company were to distribute all its profits. There is interestingly no test of votes, so there doesn't have to be a substantial reduction in your voting control over the company. So in theory, at least, you could retain one golden share that had more than 50% of the votes of the company. But it's a bit unlikely that you would then be satisfying the trade benefit test, because if you still control the company, you can't see what trade benefit there is in the company buying all your other shares from you.
Agreed.
But those are the substantial reduction tests. What are associates?
Associates are spouses. You've got to be living with them though, and civil partners. And it's minor children, I think, isn't it? This is section 1059, forgive me, of the legislation. Separated spouses are not associates for these purposes.
They don't count, yes. Which is why you can still, you can meet this condition. One of the circumstances that you might be buying shares back is in a marriage breakup, where at the time of where husband and wife own shares in the company, and one of the spouses is being bought out of the company by the other, effectively by the other spouse, by the company, leaving the continuing spouse having all the shares in the company. Clearly, there wouldn't then be a substantial reduction in the aggregate interest of the spouses, because there's only two of them. But they're simply not associates. Once they're separated, they are no longer associates. So you don't have a problem in that circumstance. And we will talk a bit about the interesting case of buying shares back on a divorce, I think, which you mentioned while we were talking about this earlier.
Did I? Okay.
You did.
All right.
You did. I'll prod you when we get there.
Forthcoming attractions.
Yes, so that's substantial reduction. Is this an example?
It certainly is, Mr.
All right,
Wilson.
okay. So vendor owns 50 out of 100 shares. He sells 30% of his holding. So that's more than 25%. So the naive might say that's all right. So his prior interest is 50%, because that's 50 out of 100. His subsequent interest is now 35 out of 85, which is 41.18%, and 41.18 over 50 is more than 75%. In fact, 82.35%. So that's not a substantial reduction. So even though he's sold more than a quarter of his shares, he's not made a substantial reduction.
So that just illustrates the point.
Yeah.
Because the share capital base of the company has been reduced, hasn't it?
Yeah.
Right. So as we see a lot of tests, there's a further condition: you can't be connected with the company post sale.
Yep. And we've got the definition there of being connected. over 30% of the issued share capital by nominal value, or over 30% of the loan capital plus issued share capital. We've got if you ignore loan capital, if you're in the business of money lending and you take no part in the company's management or conduct, or you mustn't have rights entitling you to more than 30% of assets available to equity holders on a winding up or in other circumstances. And the definition of equity holders is in section 158 to 164. But life's a bit too short to go there at the moment.
All gets become. So this is a further thing. We talked about substantially reducing your shareholding, but you've got to get it down below 30% anyhow.
Yeah.
We've then got the revenue issue on the trade benefit test that says pretty much.
But these are at least objective tests. You can tell whether you meet them or not. And importantly, rights and powers of associates are attributed in this case. It's not just you having connectedness, it's you and your associates between you having connectedness.
And this is the sort of thing that precludes you from saying, well, I'll do a share buyback but lend the money immediately back to the company. You might have a problem there. You do that sort of thing. Not recommended, because there's various disqualifying events, aren't there, the legislation talks about.
And to save argument, anything that happens within a year of repurchase is deemed to be part of a scheme or arrangement that exists at the time of the repurchase.
That's the point,
so
there's no point thinking, well, I'll wait a week. They've thought of it all, haven't they? To be fair, they've done a pretty good job.
Pretty good job.
Okay. So there are some relaxations, though, aren't there, David? Help us out here.
It's you don't. This is unlikely to happen very often. I think I've only come across it once in a long and disreputable career in taxation, but in the circumstances when it applies, it's a lifesaver. And there's a special rule for a seller for whom the where you've got somebody who's making a sale of shares where he doesn't meet his sale meet the substantial reduction test or the connectedness test. So his test isn't in fact met, but who only agreed to the repurchase of his shares in order that the test could be met in regard to a repurchase from an associate. And it's easier to give an example than it is to explain it in abstract terms. So you've got a share capital of 100, should we say, and the vendor who actually wants to sell his shares holds 50 of the shares. So this vendor who actually wants to do the buyback,
right?
So holds 50. An associate of his holds 20. An associate, we've talked about associates being spouses, but there might be trusts or associate companies sometimes. But an associate holds 20 and other people hold 30. So company buys back shares from the vendor, buys back 50. That would leave the associate with 20 out of 50 shares, which is 40%.
So he's connected.
So in order, and that, because the associate would be connected, would disqualify the vendor from capital treatment. So in order for the vendor to get capital treatment, the associate says, okay, I will sell enough of my shares to reduce my shareholding below 30%. So you, the vendor, can get capital treatment. So associate on these figures needs to sell 8 to reduce his shareholding to 12 out of 42, which is 28.557%, which is less than 30%. And the associate, therefore, gets capital treatment for his own share repurchase, despite himself failing the substantial reduction test. In fact, not only does he fail the substantial reduction test, he has a substantial increase in his shareholding. It goes up from 20% to 28.57%. But because he's only entered into the sale in order to facilitate the vendor getting treatment, or allow the vendor to get capital treatment, he gets sort of piggybacked onto the capital treatment. Very interesting.
Not a lot of people know that, do they?
Not a lot of people know that. As I say,
it's a very subtle point, albeit, as you say,
it's a lifesaver when you need it.
So, okay, right. We touched upon this before, but let's just cover off the post-transaction notification, which broadly says, I think it's within 60 days, isn't it? You have to write to the revenue and say, we have done a buyback that qualifies for capital treatment. Now, you may have had clearance already, or you may not. It may be your view it does qualify for capital treatment, but this is to allow the revenue to satisfy themselves that you get the capital treatment. And I think I'm correct in saying if you've gone for clearance, all you have to say is we've done the buyback, it's wholly in accordance with the clearance that you've already seen, dated, whatever it is,
Yeah.
all is well in the world.
Yeah.
If you haven't gone for clearance, then you need to set out why you satisfy all the capital condition treatments in theory, otherwise the revenue will in all likelihood ask you questions.
Yeah.
But the principle is there, don't forget, it needs to be done, albeit in my experience it seems to be missed rather often, and I've yet to see the revenue take the point, albeit, as I think you've referred to in the slide, David, there are penalties, and quite severe penalties actually. £300 for failure to notify, and when you say get it wrong, that's when you say you get capital treatment, but
if you negligently make an incorrect return, negligently or fraudulently make an incorrect return, it always seems to me, I shouldn't encourage people not to make returns, but it always seems to me if it's going to cost you £300 not to do it, or £3,000 to risk getting it negligently wrong, some would say that you're better off
doing the maths.
But anyway.
I take it they can't, if they issue you with a penalty, is that then any further penalties if you then fail to make an appropriate return?
Well, if they issue you with a penalty and you don't make the return, then there's another, I think, £60 a day or something, but only once they've issued the initial penalty. So you can't. It's not a case that the revenue company say, aha, there's £300 penalty for not doing it, and there's another £60 a day for 25 years for continued failure. That continued failure only applies for continued failure after you've been served with the initial penalty.
Okay,
so you ought to do it.
You should. Let's be nice.
Somebody's asking if there's a recording available. I think so, isn't there?
There will be.
Hopefully.
It will be sent to all of our lovely listeners. After we completed the webinar, hopefully this afternoon. Right, moving swiftly on, as they say. We've been focusing very much on the tax aspects of this. We should not for 1 minute forget that there are various company law requirements concerning share buybacks. And it's important these are considered. Indeed, these can often be the deal breakers, can't they, David?
Well, I always get somebody who knows about these things to advise on companies.
Well, just the headlines.
Yeah.
Excuse me. That you can only buy back out of distributable reserves.
Yeah.
And you must pay immediately in cash for the shares.
But when you say out of this, you can do it out of a fresh issue of shares, of course, can't you?
Correct.
But the key point is the shares must be paid for on purchase.
And I think in cash as well, the legislation.
Well, the revenue
company law says.
The revenue certainly takes a view that it must be paid for in cash. And the revenue won't give you clearance for a transaction buying shares in kind. And frankly, I've always acquiesced in that, whether it's right or wrong. It's the revenue's view, so that's the revenue's view.
Yeah.
What happens if you get it wrong? Well, there's a case of Baker in 2013 that was essentially this was a company that bought some shares back, or purported to buy some shares back, and the guy omitted to put the transaction on his tax return, I think. And it was pointed out when the revenue challenged the tax return that the new accountants actually said, well, hang on a minute, the company didn't have the reserves to buy the shares back. We didn't go through any of the proper company law procedures. This because the transaction was void. There just simply wasn't a buyback. There wasn't anything to go on the guy's return. And broadly speaking, the tribunal agreed.
Yeah, I think it threw the revenue a bit of a curveball, didn't it?
It did indeed.
From reading the correspondence.
Yeah. There was some issue, and I'm not sure whether the tribunal got it right or not. But the money had come out of the company to the shareholder.
Yes.
He had physically received the money from the company, and there was some question about whether he held the money on constructive trust for the company and had to hand it back, or whether he'd been loaned the money by the company, and if it was a loan by the company, whether it was a beneficial loan or whether it was a shareholder loan, or whether Section
455
applied. And the tribunal in that case decided that there was no loan, it was simply holding the money on trust, and therefore those beneficial loan and 455 issues didn't arise. I'm not sure whether that's right or wrong. Obviously, it's better to get it right. But the point is that there are lots of company law issues here, and getting them wrong can cause a certain amount of fun.
And Kevin Slevins actually wrote in Taxation about this last month. There's a whole article on the Baker case. If any of you would like to look into that in a little bit more detail. It also crops up on the tax clearance. I've seen the revenue, when they do raise questions on the clearance for a buyback, they have asked specifically to confirm that the company's articles permit buyback of shares. So there's another little nuance there and something just to cover off. Well,
yes.
Should we read the question? Should we give the question before we give the answer, David? I think that'd be helpful. Okay. So David's asking us, he's actually picked up on Kevin Slevin's article, 23rd of May, saying failure to meet the Companies Act requirements renders the transaction being void. Now, we are not company lawyers, we would hasten to add.
I'm glad you prefaced our remarks with that. Do we agree? Yes. Are we giving suitable advice that we agree? No. But I agree that on the face of it, the transaction would be void, and I think the analysis that it's void is what I would expect it.
Okay. So yeah, again, there's lots that can go wrong here, both from a tax perspective and from a company law perspective. So it's very important that, along the face of it, it's quite a simple transaction, isn't it? You write me a check, I hand you my share certificate back. Make sure you get it all right. And we'll come back to this point about being void now, because we don't know the answer to this next question, do we, David, necessarily? I've referred to before about a clearance I'd seen from HMRC where they very helpfully wrote to the accountant who'd asked for the clearance and said, no, it doesn't work, you won't get capital treatment. How about doing it this way? And this is to do with the point we've made. If the company doesn't have the cash or the reserves to buy back all of the shares now, you can't leave the consideration outstanding. That just doesn't work from a company law perspective. It also raises various tax issues, but if it's a void transaction, you don't need to worry about the tax analysis. One thing you can do is say, if you wanted to buy back, I don't know, Mr. A's 1,000 shares now, but you don't have the £200,000 that purportedly these shares are worth, you can enter into a single step contract today with step completion date. So you say, we agree to buy back all of your shares, Mr. A, all 1,000, but I'll buy back 500 of them now, say 100,000, and 500 of them, the rest of your shares, will buy back in a year, at which point the company will have the reserves and the cash to do so. The revenues view is always, well, that is a unconditional contract. You have sold all of the shares for CGT purposes today, so you meet the requirements that you're substantially reducing your shareholdings, and that allows us to deal with this situation where the company simply cannot fund the buyback today. Now, it does raise various issues. You've got a shareholder there who still owns 500 shares. Does he get dividends, etc., etc.? That's, I think, a talk for another day. The point has been raised, though, about entrepreneurs' relief. We said before, it's not a given entrepreneurs' relief. It's a slightly different test, albeit in most cases, I would imagine, if you get the capital treatment, you would get ER. But as David's talked you through, that's not necessarily the case. The point has been raised whether or not you are entitled to entrepreneurs' relief on that second buyback. Now, the real question is, when is that deemed to happen for CGT purposes? Section 28 normally fixes the date of disposal of the date you enter into an unconditional contract. The question has been raised as to whether Section 28 is relevant in these circumstances, because that relies on a sale and an acquisition of shares.
So 28 specifically refers to the contract under which an asset is sold and acquired.
And we'll come back to that point maybe in a second. So there is some doubt as to whether or not you will get entrepreneurs' relief, because instead there is a view that you have to satisfy all of the ER conditions at the date you complete that second buyback. Now, it's just a normal test, but if you have signed a contract today to sell all your shares and walk away, then it is likely you will no longer be an officer or an employee of the company. There is some doubt. I don't think it's entirely clear how the legislation applies. It may be, I think, prudent, would it not, David, perhaps to stay on as fourth assistant secretary or in some sort of part-time role, albeit that may cause difficulty in satisfying the trade benefit test. So not easy to square that circle.
Question whether you pass the trade benefit test in those circumstances. So I don't know the answers to to the particularly to the entrepreneurs relief question.
All right, but yeah, I mean, we've seen in the past this step completion, and I think it's relatively new. This point has been raised. Just one other quick point, David. A share buyback, can the market value rule apply?
Yes and no.
Okay.
The market value rule applies in two circumstances, I believe. One is where an asset is disposed of and acquired by a disposer and acquired by an acquirer, and they're connected. Well, that can't apply because the company isn't acquiring shares.
Yes, and that's what's prompted my question.
Yeah.
Okay.
So it can't apply because it's a connected party transaction. I think it may apply if it's not an arm's length transaction, because an arm's length transaction doesn't require an acquisition and a disposal. I think the more likely result of there being some tinkering about with the market value is that you maybe wouldn't get the trade test. You wouldn't get capital treatment. I'm thinking of one case in particular some years ago where divorcing husband and wife, and the deal was that the wife handed over the second home, holiday cottage, whatever it was, for a soft price, in return for which the husband procured that the company bought the wife's shares out of the trading company for what was manifestly more than they were worth. But it meant that his burden of the divorce cost was borne by the company, not by him personally, which on the face of it was sensible planning.
Yeah.
And sadly, the revenue didn't give clearance for the. In fact, I think it was a case where clearance wasn't sought. Actually, I think everybody assumed that it would be a capital payment, but the revenue denied capital treatment on the buyback because the company was manifestly overpaying for the shares, and therefore that wasn't for the purposes of its trade.
Okay. Couple of quick questions. We'll squirrel them in before we finish up for today on alternatives to share buybacks. David has come back to us on our share buyback and company law aspects, and would a stepped completion route make the transaction void because you're not paying everything in cash? I think you're okay on the basis when you complete the second step, you pay in cash. I've never seen the point taken, so I think from a company law perspective, you're okay. Well, all right, we'll leave it there. So, interesting point John raises. Employment-related securities, if you buy back the shares, could a chapter 3D? 3D is it sale at overvalue, I think? Well, I think the principle is there. If you are receiving manifestly overvalue for your shares, then yes, it's a fair point. Thank you, John. You may have an employment-related securities charge. And, well, you may have two income tax charges, what we're saying, because that could well preclude the capital treatment.
Yeah, it's interesting, actually. We've talked about capital and income treatment. Technically, what the clearance is, it is not a distribution. It's not saying it's not chargeable income tax.
Yeah.
So if it is indeed a chargeable income tax because they're employment-related securities that are being sold for more than their market value, then even though all the other conditions for capital treatment might apply, I see no reason why the employment income charge wouldn't be relevant.
And a final question, the light bus is, if the seller keeps a small number of shares and stays on as a part-time employee, would there be a connection?
Well, there wouldn't be a connection.
However,
because connection is objectively defined as having 30% of various things. So there wouldn't be a connection. What the question would be whether the payment met the trade benefit test. Again,
this is more subjective, isn't it?
Yeah.
The revenues views generally, you do have to completely walk away.
Yeah.
It's not definitive.
Staying on for a bit to hand over the reins is one thing. Carrying on as a part-time employee forever is different.
Okay. Right. So that's a tour through the conditions to get capital treatment, or whether it's an income distribution on a share buyback. Now, as you can see, there's lots of pitfalls. It may well be that a share buyback will not allow your shareholder to avail himself to capital treatment at 10 or potentially, as you quite correctly pointed out, 20%. What other alternatives do we have, David, if for whatever reason you can't go down the the share buyback route and you are looking for capital treatment?
Well, the classic alternative is to do effectively a management buyout or management buy-in or bimbo, whatever they're called. It's simply an acquisition by a new company, where the new company acquires the shares of the staying shareholders on a share-for-share exchange, and a new co pays cash or leaves the proceeds outstanding on shares for the leaving shareholders. So it's simply a new company set up to acquire part paper for paper, part for cash or loan, and they've got a number of advantages there. There's no restriction to trading companies for the money. There's no minimum ownership period. There's no substantial reduction requirement. There's no connectedness requirement. So
what's not to like?
What's not to like? Well, what's not to like? It might be it is a transaction in securities, plainly.
Clearly, yeah.
And because it's a transaction in securities, there is potential for an income tax charge. I mean, in the most extreme example, I own 100% of the shares in a company, and I want to extract some cash, so I sell all of my shares to Newco, and I sell half of them for share exchange, and I sell the other half for cash, which Newco pays to me, having set the dividends out of Oldco. I'm left now holding still 100% of the shares in the company.
Yep.
Except that I've now received cash equal to the value of half the company that I've extracted in a capital form, because it's in the form of a sale from our shares. Now, you could apply for clearance for that under the transaction in securities rules. It would be a complete waste of paper and ink. So it's the sort of thing I'm getting at, is that it's easy to look at this sort of transaction, but the major problem with it will always be a question of whether what you're getting out is in the nature of a distribution. And it would tend to be the revenue's view that if you would have failed to meet the tests, if you've done a share buyback, then they're likely to look askance at whether the transaction securities legislation is satisfied.
Yeah, I kind of get the impression they're looking a bit more closely at these now, aren't they?
Yeah.
Things that might have gone through in the past. The other thing we've not mentioned today is stamp duty. Where you buy back shares, it is a stampable transaction.
It is
0.5%.
It is. Yes.
Where you go down the holdco route, the disadvantage as well is you may well be paying stamp duty on the whole of the value of the company, as opposed to just the value of the shares being bought back. Albeit that we may be able to mitigate.
Things you can do about it, but in principle, you're absolutely right. You're absolutely right.
And I think that concludes our tour.
Yep, looks like it.
Of share buybacks. So thank you all very much. We will be circulating the slides to you all later. If you do have any questions, feel free to email us, and we do our best to respond. If you've any topics for future webinars, anything you'd like David or myself or any of our learning colleagues to talk on, we'd be delighted to hear from you as well. We are going to try and squirrel one more in, I think, before the summer season starts. So thank you for your time today. We hope you found that useful, and we look forward to you joining us again soon. Bye-bye.